Hey guys, well, welcome back to Real Estate Analysis 101. I'm Paul Hunter. I'm a realtor here in Houston, and I've been here for about 7 years now. I'm from Colombia, South America, so I know a little bit about high inflation, high interest rates, and high unemployment. Today we're covering Redfin's housing market update, but before that, a quick thing. I am not your financial advisor, but I do appreciate likes, comments, and subscriptions to my channel, so please do all three. Now, let's get started. Before we get started, however, I do want to reiterate, I am not a doom and gloom kind of guy. I'm just delivering the facts. The trouble is that if enough people buy into the doom and gloom, it will become a reality. People will start acting in those doom and gloom mindsets, and guess what? They spend less, they expect things to go worse, and guess what? They do. So I'm not here to blow smoke up anywhere, but just remember that economics is mainly an activity, a human activity that is a result of psychological backgrounds. And if enough people line up and create a critical mass in a particular psychological expectation, well, that's what we're going to get. So before we get going, also, I want to make sure we understand a very basic principle of real estate, and that's what's called, what is it? Is it a seller's market, a balanced market, or a buyer's market? So by definition, a balanced market is we have 6 months worth of inventory. If nothing came on the market right for the next 6 months, and it took us 6 months to sell it, that would be, traditionally, that's a balanced market. Anything less than 6 months is a seller's market, and anything more than 6 months is a buyer's market. So before we get started, I just want to make sure people understand we are not in a balanced market. We are still in a very heavy or extreme seller's market. Now, it's not as it was 2 or 3 or 6 months ago, but we're still under those 6 months by a lot. We're somewhere under 3 months worth of inventory. So let's get started with our Redfin housing update. Okay, so according to Redfin News, the U.S. pending home sales fell 35% year over year during the 4 weeks ending October 23rd. That represents the largest annual decline and the fewest homes under contract in any October since at least 2015, when Redfin's weekly housing market records began. So that just means that we have a whole lot less homes going under contract. But if we compare it to a couple of years before, we will look at that and see how we still have, as I said before, we still have a seller's market. There's still a lot of inventory that is, there's a lot of buyers out there that can't get the inventory that they want. Now, another important point here is but now both mortgage purchase applications and pending sales are below 2018 levels. Now, if we remember, 2019 was an excellent year. Now, after COVID, we started in 2020, everything changes. And so it's such an anomaly that people are going to understand that it just skews everything. And I want to show you a slide that will tell us that. So here we go. This is the home prices every year. So this yellow line is the historical trend. It's about 4% a year. That's what it shows every year since 1920, I think, is the beginning of that. So anyway, we are obviously above that trend line, which means that there's going to be some kind of a correction, sort of like what we had here. So if you bought a home, in the last 6 months, you cannot expect to be making a profit if you sell it in the next year or so. Another thing we need to understand is that real estate normally is a long-term investment. We don't do that for flipping unless you're very good at what you're doing, and that's a totally different situation. But for most people, home buyers, their home being their biggest investment, it should be no less than 4 to 7 years. So yes, you will see some correction if you bought the home in the last 6 months or so. But if you are selling your home, if you bought it 7 years ago, and again, I'll give you this example, really low round numbers, make it easy. If you bought your home 7 years ago for $100,000 and you expected to sell it for 150 or 160, which is what you could have sold it maybe 6 months ago, you would be making $50,000 or $60,000 over the purchase price, right? Now, if you can now sell it for only 140, and I say only, did you lose $10,000 to $20,000, or did you make $40,000? Again, that's depending how you look at it. If you feel that you could have sold it for 160 and yet you got 140 for it, you might feel that you lost $20,000, but in reality, you made 40 because you paid 100 for it. So that expectation is really a hard one to work with. I work with a lot of sellers, and anytime they overprice their home and they have to, because they want to have wiggle room to negotiate, when they come down, instead of noticing that they made more money than what they paid for the house, they're looking at the fact that they didn't get that additional margin that they were using as a wiggle room, but in reality, they were expecting to get that. So we have to be very realistic in terms of how all of these things work out. So let's go back to inventory. I think we have another slide. No, that's not. Very important part here, the inventory levels that we have in our market. This is all of the US. So if you look at these different the different colors, the yellow is 2020, the purple is 2021, and the aquamarine is 2022. So if you see in 2020, we had a 3.1, 3.1, 3.3, 4. In other words, this was sort of this was when COVID hit. So we were getting people weren't buying, weren't going out of it. There's a lockdowns and all that sort of stuff. So it started getting a bit more normal here. In other words, getting in line with people getting out and buying homes, right? And we saw the crazy markets where everybody was buying at extraordinary prices. So if you look at 2022, this is July, obviously, but we have 3.3 months of inventory, and that hasn't changed very much in the last 3-4 months. So if you look at 21 and 22, or actually 20 and 21, we're looking at 2.7, 2.4. All these are very extreme sellers market. In other words, the inventory is low. Buyers don't have a whole lot of options to buy. So what does it look like? We do know that the market is coming down. Prices are coming down, partially because I think they were overinflated. I think they were overvalued. If you were able to sell at those price points, awesome. A lot of my clients did. And a lot of my buyers missed out. And I had to, in a number of cases, give them my considered opinion not to pay that kind of premium for those homes, because they were going to have trouble paying for that. And we'll talk a little bit more later on in the video about that part. But again, if you bought in the last 6 months, do not expect to make a profit if you sell your home in the next 6 months. That happened for a very short period of time in 20 and 21 and the beginning of 22. But that's not a normal market. That's not what's going to happen. That's not why we normally buy homes. So remember, real estate is a long-term investment. It's not something you do for a quick buck or make a quick profit on a flip. That's a totally different situation. And even those you do it with a time frame of maybe 2 or 3 months, even more than that. Now I want to go to a different source of information. And as we expected, last Thursday, the Federal Reserve increased its benchmark by 75 basis points. And I want to make sure that people understand what that means. A lot of times people 75 basis points, that people don't know what that means really, but 75 basis points is 0.75%. In other words, it's 75 tenths of a percent. So it was less than a percentage point above what they had before. And a lot of people were expecting that the mortgage rates would go and do the same. However, I want to share this with you. This is not what happened. If you look at this chart here, we have the 30-year conforming loan, that's a benchmark that they have, was 7.096. That's 0.02 percentage points below. All of these loans, this is just an average, so don't get hopeful yet. But the thing is, if you look at this, it is still a smaller. If you look what happened here, right? In November 4th, we had a 7.1. November 7th, 7.15. November 8th, 7.18. And then it's 7.096. So those are slight. These are actual averages of mortgage. So what I'm trying to say is that people were expecting, or the experts were expecting, the mortgage rates to go higher even because the Fed raised their interest rates. However, a lot of times people don't understand that that expectation of the experts or the lending institutions, they bake into their numbers that expectation. So they raise those rates. If you look at them at this, they had raised those rates here. So when the Fed raised the rates, it didn't cause a rise in the interest rate. They had already taken that into consideration. Now, will that continue forever? We don't know. It depends on how, again, psychological processes, and even the experts go through a psychological process and they expect something to happen or they think something will happen, and it's all a psychological process that will end up being an economic result. And one thing that that people are telling you doom and gloom, and I know that it sounds sometimes pretty bad, but even in the worst of the 2008 and 9 Great Recession, there were still homes being bought and sold. So this is one of those things that I really want you guys to understand. The market is always local. So check your local data and jump on any opportunity that you might have. And as realtors, I mean, my colleagues, we must be trusted guides for our clients. We must provide data and perspective so that people know what to expect and how to act in certain situations, not overreact and then fall prey to the fear mongering and the hype. And then all that creates is a worse situation for everybody involved. So one thing that I want to bring up with this, we need to break through fear of the changing market and to show buyers and sellers how a pro gets it done. This is how we should be doing. And the first thing we need to do is start separating fact from fiction. So we need to recognize that media outlets and social media influencers are competing for scoops and eyeballs. In other words, they're clickbait. As a result, the reports sometimes exaggerate issues and don't tell the whole story, or they get it wrong. What's being said, whether it's true or not, becomes the optics for the consumer. I've been saying this forever. So we keep hearing that when the interest rates started to rise, the sky is falling. Is this 2008 again? Well, not necessarily. A lot of things are different today than they were in 2008. Is the market slowing down? Yes. most definitely. But is the market crashing? Not yet. Not unless enough people align and become a critical mass of expectations of crashing will that happen. So again, it's easy to be influenced by dramatic headlines, but when you drill down on the facts, you discover that the market isn't crashing. It's just shifting towards a slightly less frantic pace. And that's not a bad thing. Not a bad thing. So we need to take into consideration housing demand remains strong, inventory is tight, and prices continue to rise nationally. Nearly 40% of homes are still commanding full list price. Now, this is a national average. You still have to go into your local market to see how that's happening, even in neighborhoods. I mean, it's that granular. You have to be able to drill down into the granular level and see if the area you want to buy, is that the one? Is that market going up or down? And that depends on very local factors. So yes, interest rates are a national thing and it affects everybody. Inflation is a big national item, but again, inflation can also be localized. Some places will have higher gas prices, for example, than others, and that affects the inflation rate. So I just want to bring a little bit of perspective. I know that everybody's out there telling you doom and gloom and the market's crashing and don't buy. Now, and this is what I was talking about at the beginning. The market is slowing down for real reasons, as we said before, the inflation, higher interest rates, and other maybe local factors that affect each market differently. But sell if you must, buy if you can. And by that, I mean, if you have to sell because you're getting a promotion, you're downsizing, there is really a good, valid reason to sell, go ahead and do that. Shameless plug, get a realtor to do that for you, help you out with that. But even if you do it yourself, be aware of what the pricing trends are in your local market. What you're going to see nationally is sort of a big picture indication, but at the end, somebody's buying a home on a street, not in the United States. So again, sell if you must. If you have a real valid reason, you are probably not going to make as much money as if you had sold 5, 6, 7 months ago. But prices are still average. On the average, are still higher. So you're still going to be able to sell it for more than you paid. Still not as much more, but more. And if you're a buyer, buy if you need to, and if you can. And this is the important part. You have to always look at the monthly payment. In other words, is the monthly payment something you can afford? Because you're going to be in that home or trapped in the mortgage for a while. So is your income enough to pay for that? Is your income enough to comfortably live without sacrificing your basic needs, groceries, fuel, that sort of thing? But it's if that payment is something you can afford, it's something and you need to buy, and you can, go ahead and do it. You're probably going to be in that home for a while. So even if it corrects a little bit and comes down, the trend line is still 4% a year. So if you're going to be there for 5, 6, 7 years, which is sort of the average, although that's getting up a little bit higher than that, we have there's a good chance you will, in the worst case, maintain the value of your investment. In other words, the money you put in there, you'll be able to take it out. Your money won't, or your assets or your equity will not be diminished. So guys, I hope you got some value from this video. Please let me know in the comments. You guys know that I want you to gain an understanding of the psychology behind economics. You can make better real estate decisions. I'm not your financial advisor. I'm just a realtor that wants to share my insights so that you can learn from my mistakes and successes. And when you're out there, be good or be careful, or both.